Welcome back to the pod. Thanks for joining us for the next episode of Reimagine Ownership. I am privileged to be joined today by two friends, Luke McFarlane and Mark Riccio. They aren't in the United States. They are all the way on the other side of the earth in sunny Australia. And yet we want to tap into their expertise and their knowledge to talk about where the markets are today, where we see things headed in the universe of all financial instruments that are decentralized. Guys, welcome.
Thanks for having us.
So I want to start with a short overview of Vikara, which is the business that you guys run. And maybe I will ask Luke to kick off by just explaining a little bit of the genesis story. And then I want Mark to answer my next question about some of the specifics of the strategy that you've been executing.
Yeah, for sure. Thanks for having us, Dan. So Vikara is a long-only digital asset fund. We are focused on everything outside of Bitcoin and Ethereum. The genesis of the fund, Mark and I have long backgrounds in traditional financial markets, both in asset management, investment banking, private equity, and corporate finance. We really wanted to provide a service for investors to manage their capital in this space with the fundamental rigor that traditional markets operate on. We've gone about conducting due diligence on all the tokens we own, most of the tokens in our universe. We go about putting together a portfolio based on what we think are the best tokens that will, over the long term, have large market shares around the infrastructure and markets that they're going to take share in. So we're trying to put together all of the institutional bells and whistles that you need, the best custodians, the best service providers, audited financials and track records, and ultimately ratings as our track record gets longer. So, Mark, anything to add on that one?
The only thing I'll add there, Luke, is, Dan, when I guess we started this fund, when I was still at Macquarie, Luke was at Platinum, we got the idea, we were involved together and some other things. And we had both sat in seats where we had a large number of limited partners. And the limited partners, as a hedge fund or a private equity group, would never allocate, or very few would allocate in 2021 to a crypto for a number of reasons, right? It would be very challenging for a team to go to a CIO inside a Texas Teachers and get a check for a crypto fund, whether it be a Bitcoin or, long only alts. And so, we were looking around and saying, this may not happen today, it may not happen in 5 years, but can we put together a fund that you could legitimately sit through a due diligence session, pass a DDQ, the rigor of, a large pension fund or endowment or super fund or a sovereign wealth fund, and get a check from someone. And I still think, given some of the volatility over the past few years, it's still very challenging to do that. You might not even get airtime at any of these institutions. But if this asset class eventually thrives, that will happen. And, we'll already have, as Luke outlined, we'll have the track record. We'll have we have a data room with all the information you'd expect if you were doing due diligence from at a traditional equity, long only equity or hedge fund. So that's really the genesis there. And as Luke said, we have gold plated this, rightly or wrongly. And that's been received well by a number of our LPs who would expect to see that.
Well, I want to double click on something that Luke said and hear your view. He kicked off by talking about how you intentionally exclude Bitcoin and ETH. And that's part and parcel of a thesis that has been close to our heart, because Metaversal has primarily been focused on one of the alts, which happens to be the NFT ecosystem. And yes, we interact a lot with Ethereum and Bitcoin to an extent now, with the ordinals and Solana to a lesser extent. How have you framed that positioning, in the sense that, does that give us insight on where the most interesting innovation is going to lie, or where some of the inefficiencies still exist? Because notwithstanding that thesis, which we tend to subscribe to, the market has actually moved in the opposite direction over the last 6 months, right? We see Bitcoin dominance now at basically all-time highs. So how have you reconciled that in your head?
Yeah, so I think it's first and foremost, Luke and I saw the writing on the wall with ETFs. So if a high net worth or a LP from Wisconsin, the university, I think it's Wisconsin Investment Board, they've allocated hundreds of millions of dollars to Bitcoin. Well, they can do that cheaply, effectively at 0 basis points inside an ETF. They don't need to pay a fund like ours a management fee and performance fee to be allocated to 70% Bitcoin. I think on your second question, I think it's a bit of both. You have arguably been punished for using fundamentals in this space over the last year. We've seen platforms like Pump Fund churn out literally. I think the last time I looked, it was 8 million tokens and 2.8 had liquidity pools. So, that's 2.8 million tokens that most of which are completely dead today. But it did suck in liquidity, and it sucked in attention, and it sucked in the limited amount of money that normally someone may have spent last cycle. And I'm not saying most retail digital asset investors go and do hardcore fundamental analysis on a SUI or a RWAs or whatever the name is. But very few people there was zero attention spent to those that are actually trying to build solutions in a Web3 context. And so what we do is, just from a fundamental perspective, we have a number of people we can call, and Luke and I are both, as Luke said, financial background. So, we're not going to dig into the details, but we do get people to come around and say, this technology legitimately could displace some Web2 businesses. And then we'll dig in and, we'll look at things like tokenomics, we'll look at team, just as you would do in a traditional sense in a equity, if you run an equity book. So I'm not sure if that totally answers your question, but, we don't want to be, if someone's allocating, like you've got Fidelity who said you have to be, or you should be 1% to 2% digital assets. We just want to be a small component of that digital assets. And we've seen that with our existing investors, where our LPs may have exposure to 5 or more funds, and we may be 10 or 15 or 20% of that larger.
Yeah. And Dan, maybe just to add to that, Bitcoin is a debate around fiscal and monetary responsibility globally. It's this debate around whether you can have a digital store of value or not. There's not a lot we can add to that debate, really. There's not a lot of differentiation that Mark and I can come and actually try and provide our LPs in that debate. You either believe that there's a place for Bitcoin to take share there, or you don't. And then people look at Ethereum as, Ethereum's everything else. So there might be something cool that comes out of blockchain, but it's probably going to be on Ethereum, or at least this was the original thesis. And so I'll get some market share if I'm long Ethereum at the same time. Like that, from a two talking points to us and to you as well, is hilarious, because there's unbelievable amounts of opportunity that are bubbling away under the surface, but it takes time to find. It takes a lot of discipline, go through the due diligence process to understand who we're competing against and why, and then how ultimately we take share without just financial demand. And so we spend a lot of time thinking about market structures, oligopolistic industries, how Web3 can actually take and redistribute those margins being earned by centralized businesses. And then ultimately, there's even a place for this technology. And 99% of the things we look at, we can't get to the other side of the due diligence process on. But of the things we do, we feel great about. We know that they've got very viable long-term business models. And it's really about how we best manage through the volatility and the liquidity profile of this space, which is very low, but hopefully it grows, considerably through time.
Well, I want to talk about the macro environment because it's hard to ignore. But I want to do that pre-tariff imposition, because I think there's a very interesting dynamic from even a month ago. When we got together and spoke in early 2024, there was a long wish list, things that we hoped and were optimistic would happen in terms of regulatory normalization, in terms of user adoption. We fast forward to the end of 2024 and now early 25. And I would submit to you that more things on that list have happened than not. And yet, market price appears to indicate something quite different, right? Market price sits there as though regulatory normalization. So how do you reconcile that in your head? And how do you explain it around the dinner table to family and friends?
Yeah, it's a good point. And fundamentally, we see a lot of that, Dan. There's a lot of positive things happening, regulatory, from a regulatory, but even just company or token specific. But take a step back, actually. We've had a tight monetary policy in the US for the last 12 months. And if you remove the ETF buying and Michael Saylor from the Bitcoin price, I don't think we would have seen a start of a cycle yet. I think a lot of what we've seen is really just ETF buying and Michael Saylor's inevitable money printer that keeps buying Bitcoin. The Fed hasn't pivoted. The macro hasn't changed. People are still very worried about inflation. And until we actually see an environment where we can have looser monetary policy, particularly with a backdrop of fiscal tightening as well, you're actually looking at much less money being printed this year than you have in a long time. And so we would argue actually that while the fundamentals of our space continue to get better as they have over the last 2 to 3 years, from a macro perspective, it's still a really challenging environment for long duration assets. And it will be until you see meaningful inflation or disinflation coming through and you see a Federal Reserve that is willing to actually loosen its grip on rates here. The constant threat of tariffs and the constant uncertainty around whether we have tariffs, whether they cause inflation or not, makes it much harder for the Federal Reserve to move, even though there are a lot of leading indicators that suggest inflation is coming lower and disinflation is very likely over the next little period of time.
I want to ask you about your vehicle structure. You guys made a conscious decision to do something that was more liquid, more open-ended. How have you thought about the design of your investment vehicle, recognizing that we're at this interesting crossroads where we are accustomed to traditional investment vehicles, traditional investment products, and yet every day we're seeing more and more innovation that allows for greater open-endedness, greater liquidity, and ultimately greater tokenization. So where do you start in thinking through that cross-section of, I would like to be able to check as many institutional grade boxes as I can, but I also spend my entire day in this decentralized universe?
Good question. So I think most crypto funds are closed-ended, or you've got a block of minimum a year, we're saying, but even a so-called liquid fund, that's about a 10-year fund, it's like a VC fund, right? It's a liquid or it's a long-only fund, but it'll have a 3-year lock. When we were looking at this, there are challenges on both sides of the spectrum. Most of our competition, if you think about digital asset funds, they're venture capital funds that are long, would charge whatever their fee structure is. There's a pref per annum and you're guaranteed 8%. When we looked at this, we said, we want the ability for our investors, especially the profile of our investor is north of, say, 40 years old, maybe older, high net worth, has made their money elsewhere, has no idea about digital assets or Web3. So having someone lock their money up for 3 years in a highly volatile asset class was going to be a hard sell, potentially, even for those outsized returns. And I think after this, we'll touch on those outsized returns and what they look like over the next few years, because Luke brought up a few points there, which I think are good to talk about. So we said, let's have an open-ended fund, realizing that, there are points in the cycle where liquidity is low. And so you've got to have a risk management strategy to deal with that low liquidity and uncertainties. And, we've done that. So when there's higher liquidity, we might increase position sizes. So, we may go from, say, 10 or 15 tokens to 30. We may go down the risk curve a bit. For example, right now, we've got a higher concentration of, call it larger caps or mid cap tokens, again, to manage that liquidity risk that we may be exposed to. Now, I think Luke and I do a pretty solid job, and we've got a COO who's been in financial markets for 25 years and digital assets since 2016. He's a former investment banker, and he's a great third member of the team that can help us manage this. Because again, like Luke and I woke up this morning, markets were down at 2 a.m. and he's had a look at the phone, wake up, and the markets are up 20%. So, when you're trying to manage a book in that sense, sometimes you can't be awake 24/7. And so you have to have that.
You can't?
No, well, Bear Luke does, but actually Luke's got a little one. So maybe, us old men, Dan, we need our slate. But you end up having a situation where you really just have to have those risk parameters in place. So just from an overall book management perspective, we never have more than 10% in one position. So one of our positions yesterday, for example, it got to 12% on a bit of a pump. We pulled that back, it's up 10%. And that's just stuff you would expect to see in a traditional sense that maybe people don't necessarily do in digital assets or haven't historically, right? And that has led to outsized returns, but then 20, 30, 40% of your book will be one token, and that's not what we're after. I guess in terms of overall structure, you mentioned how do we actually structure this fund? We're a Cayman fund. We have an Australian feeder. I just want to mention that. But in terms of the overall, how big could this fund be is, I think, part of the question you asked, because if it's and what does a fund profile look like if this is a $100 million fund or if it's $1 billion? It'd be extremely difficult to manage our portfolio today as a $500 billion fund in today's liquidity conditions, unless we went and just held the top 10 or 50. Now, over time, does that change? And as more liquidity comes here, the non-BTC market is what, 400 billion? Like, it's pretty small. I don't know what the number is today, Luke, maybe but it's small, right? Compared to the overall global equities market cap, which I think last time we looked is in the hundreds of trillions of dollars, maybe less today, but it's significantly higher, right? Maybe 100 times or more higher, 200 times higher. So yeah, long-winded way of saying really it's a function of trying to deal with the minimal liquidity in certain tokens. And, we just may have to pass on certain tokens that we may like from a fundamental perspective.
When you're assessing some of these new opportunities or existing opportunities, new primitives, how important is it to identify precisely which rails that token or that investment opportunity is utilizing versus, the fundamental thesis? Like, you guys tend to appear to be, are you more fundamentally focused investors rather than short-term tactical or technical traders? And this gets to, the growth of AI bots, which are up 24/7 and don't need to attend to small kids who are waking up with dirty diapers at random hours. So how have you thought about positioning and navigating through that environment?
You want to take that one?
Yeah, I'll make it. I mean, the rails question is really interesting. Crypto is really the only place where you invest in an asset within an asset. You've got your layer one that is either receiving flows or having flows removed from it. And then you have your token on that layer one, typically, that's trying to operate a model or trying to actually command some of the capital that's in that layer one effectively at any given time. And so we do a lot of work and a lot of thinking about the layer ones our tokens are on, and if they're a layer one themselves, how they actually compete for capital versus other rails. That's difficult. Like we look at Solana, for example. We've never really liked Solana. We've owned it for periods of time, but in general, we're not large fans. And, probably 3 months ago, it was totally obvious why. The only volumes on Solana were gambling volumes where people would come in, you'd make a new token, you'd try and steal money from someone else that was the greater fool, and you'd move on. You launch another token, and that went on and on until it became unsustainable. And, Trump was the last guy to go and launch that token. And, it's the same. It's just a series of greater fall. And we, again, Mark said earlier, we've been punished for fundamental analysis. We stayed away from a lot of that stuff. And so we probably missed the upside of guys making, and churning their book multiple times. That we took all of the downside when, Trump launched the Trump token in Melania and he sucked a bunch of liquidity out of that entire space. And we think about it a lot. It's a really difficult question. I mean, valuation, we come back to valuation, usability, we come back to the fundamental data points of adoption that we can see, and then we try and sit there and make decisions and diversify our portfolio to make sure we're not overexposed to any one of these layer ones or ecosystems that we don't necessarily really love.
Yeah, and I'll add there, Dan, think about, and it could be nuanced, right? So Sonic, which the former Phantom, they've had a ton of flows. So TVL is skyrocketing. And obviously, Andre, good leader, I guess, kind of old OG crypto guy, came back to the business. There are introducing a bunch of new use cases. They've rebadged it, so on and so forth. But, that TVL has skyrocketed on the back of people are playing a future airdrop. And so you have to say, okay, is that money flowing into this ecosystem because people are actually building on this ecosystem and people want to be part of it? Or is it specific to one event. And the minute that airdrop happens, people unstake and then money flows back out of this and this thing drops like a rock. And that's just another part of the analysis that often I bet you people don't even think about or do, and why certain things are necessarily happening instead of just pressing up. That sounds like a good investment. Buy. Because there is this whole space is driven, or I would say 75% plus is driven by the callers, the KOLs, right? The FinTwit, the hype, the momentum. And a lot of people are chasing those returns instead of saying, okay, well, why is something happening? And, our goal is to do that. And we're not alone, of course. It's certainly not the mainstream to go and do that type of diligence.
I want to ask you about this propensity to identify investment opportunities that, generally lie outside the mainstream narratives, because that's aligned very much with how we think about things. So every day there's innovation that's taking place underneath what appear to be calm waters. We know that those waters are not necessarily that calm and that the duck's feet are paddling very rapidly. If we focus on the legitimate projects, the ones that really are going to stand the test of time, move the ecosystem forward, how do you think about the role of both identifying those opportunities and whether specialized firms or organizations that have a niche strategy can help bring those to the fore and counter some of the noise, some of the casino element that does suck a lot of the oxygen and a fair amount of the capital away? Luke, you want to try? Either of you can.
Yeah, we try that, Dan. Actually, part of our due diligence process is that we can't actually get a hold of the team or get an understanding or have visibility into how they're trying to track capital. We just can't touch it. We don't go near it. And in traditional markets, you have private equity VCs that'll take a large influence on those businesses during their path, either into private markets or through their journey from initiation. And then you have this really large cohort of publicly listed funds or publicly focused funds that will then go and talk to CEOs and management teams and boards to help understand their strategy, provide feedback, and work with those businesses while they're publicly traded. Now, crypto, it's completely polar opposite in that there are a bunch of VC funds that have interest in this space. They really have interest in marking up their portfolio value as high as they can and then dumping on retail and trying to make back their initial principal. So the rest is just, gravy. And then they'll sit there and they'll dump every single liquidity unlock into the future. There are very few funds like ours that are liquid funds that actually want to engage with teams and tokens, business models, to talk with them about how they attract capital, how they attract attention, how they continue to show fundamental investors like ourselves that they're growing their business, that they're focused on market share and the prize that they set out to do. There's a lot of times we just get a blank, we're not interested in chatting with you guys, from business owners or token teams. We find that very fascinating because it's almost like a poor understanding around what actually we can provide as help for those businesses. If you think about once a VC's out, the largest seller of a token is typically that team. If they're not looking for buyers like us, which are long-term fundamental guys that are happy to take, off-market or even on-market transactions of their tokens as they're selling, they're missing a key important piece, which is that we're here to help them and support them and actually do the marketing for them. We can sit here on podcasts like this and talk through some of our favorite tokens, and hopefully others hear and others do the work and make their own financial decisions around that. But as you know, there are huge opportunities when teams that actually really do want to understand how investors are thinking about their projects and how they're growing and changing and moving in this space. There's huge opportunities to add value here, even if it's just as a sounding board to start with. Mark, is there anything you'd add to that?
Yeah, let me take a little different approach. So, one of the things we try to do is put ourselves in the shoes of, say, a financial institution or an institutional investor to say, would we invest in this token? Because the crypto trades on narratives, we know, right? AI gets exciting, more people pump the AI. And so one of the things, we own a few real world asset tokens. And it's one of the things we had a call last week with Securitize. Securitize is well known, right? Dan, Securitize guys, good guys there down in your Florida way. And what they've done with the BIDL money market, tokenizing a money market fund. And that's something that a 60-year-old gentleman who thinks this is just magic internet money could potentially get their head around. Oh, wait, okay, I can buy a share of a traditional fund that's now tokenized and it's now on a blockchain. I think that's pretty simple to explain. We don't have to go through decentralized storage and all the stuff that just confuses people. But I think those baby steps, and then we try to back in to say, well, how do we take advantage of that narrative or that thesis in a public token, a publicly traded, publicly listed, centralized or decentralized exchange way? And another one is stable coins, right? Like stable coins, it's still the killer use case today. If you can roll into a place in Thailand and use a stable pay for a pack of gum or a beer, pretty awesome. Instead of messing around with the FX charges and multiple banks. So, and that's clearly evolving. Even the Trump family came out with their own stable coin. How do we then take advantage? And you mentioned it earlier, Dan, some of that is the rails. What platforms or what blockchains are they using for potentially to take advantage of a broader stablecoin adoption globally? And I think the stablecoin is not for today's call, but that's a really interesting, are you going to have 2,000 stablecoins, or are you going to have just USDC, USDT, and a handful of others, or even are you just going to have one or two? And ultimately, what does that look like? But that's a much broader conversation that I think Luke and I are still trying to get our heads around what that looks like in a year or two from now.
I want to pick up on the issue of volatility and then circle back to real world assets. So Luke, investors are increasingly nervous about downside protection given the volatility. And if they're shaken by equity market volatility this last month, crypto has already been out in front of it, and we already suffered a lot of that. So how do you think about and how do you approach managing that volatility? And how does it differ from the types of strategies that you employed at Millennium?
Yeah, for sure. So over 2 years ago, there really wasn't a way to manage volatility. There were options markets, really thin option markets, Bitcoin and Ethereum, but you paid every bit of premium away for that option to buy a put or a call. And so it was never that profitable, or you couldn't even really see a profitable trade out there in those options. So you just didn't bother. What we tried to do from the get-go is use lower volatility assets like stablecoins, like PAXG, which is a digital gold replacement, to cycle in and out of the volatility, effectively. And so we'll just talk to LPs about how we can dampen overall volatility by using much less volatile digital assets. Today, that's changed a lot. There are groups out there that offer much deeper options markets. Interestingly, there's a lot of guys that offer deep options markets, but they'll tell you that if you actually start making money on your option, they'll close you out. And you might make 5 or 10 or 20%, but eventually you don't have an option hedge anymore. So you're often trying to roll that contract at a point where volatility is very high, where your premium, it is all of a sudden astronomical again, and it doesn't make sense for you to do it. And so if you take a real step back, what we've actually done through time is we've talked to our investors and said, look, the allocation size is the best way to manage volatility in this space. So if you're looking to put % of your overall net worth into digital assets, you need to think about how much of that goes into Bitcoin and Ethereum, the two large ones, things like VC funds that you do have lockups on, and then ultimately some portion of that flows to an altcoin fund like ours. And that allocation needs to be small enough that you're able to wear a real amount of volatility through time. Like naturally, Mark and I are trying to reduce that, and we're trying to make sure that we're managing in such a way in and out of the volatility to ensure that our drawdowns are minimized, and we're trying our best to make sure that we don't have these 90+% drawdowns that a lot of our peers have had. But having said all of that, the last month has shown us that we can be the smartest guys in the world, and it doesn't really matter because there's one guy with a tweet that can send our book down 20% or up to 20% a day. We're never going to be able to trade the bottom and the top perfectly. What we need to do is have really disciplined fundamental analysis backing our decisions so that within that volatility, we can have conversations with our LPs and say, guys, we love our portfolio. Here's why, and here's why we should be buying more down 20 than worrying about, whether we go down a further 20. I guess we're just making sure that people input the right amount so that when we do hit bumpy waters, they're okay with their position size to start with.
Mark, we know fortunes are supposed to be made during times of great volatility. So when Luke talks about loving the portfolio, do you want to shed some insight? And what aspects of what you have focused on recently do you love that you want to hug at night when we see prices moving wildly, and that you add to during special periods of stress?
Yeah, absolutely. So, just in terms of overall allocation, where we're diversified amongst layer ones, small bit of gaming, and I can delve into one gaming token that we really like here in a moment. A bit of AI. I think you have to have AI exposure, real world assets. We got a bit of DeFi, so you got we've been caught for a better place to hide, like Curve and Aave, for example. Plenty of people play, and by the way, we don't necessarily play DeFi for the reason that Luke pointed out long ago. So and maybe they complement our fund. I think, Luke, what else am I missing? We got a bit of stables in there. We've held PACG over time, which would call it another real world asset or a tokenized commodity. So, we're spread across 7 or 8 different sectors. I'll just touch on Echelon Prime. Gaming has been absolutely murdered. And, frankly, I think we all could have sat here 3 years ago and said, well, gaming is actually one of the best use cases. Like, my kids got 3 little boys. They like to play video games. How many times we've talked, Dan, you and I have had this conversation many times. How many times do I have to buy Robux or Minecraft, whatever these things are called, right? And they're in a tokenized world effectively. And, when
they can pass down the baseball glove, but we can't pass down our skins.
That's right. Well, they haven't convinced me to buy any skins yet, but for myself. Exactly. I'd look in a skin one day. So you think that is a killer use case for this space. Now, I think the blockchain gaming has done a pretty poor job at building games people want to play. And that's been one of the challenges. Gonzilla was listed last week. That thing popped to a $1.5 billion market cap. Now it's obviously a couple of weeks ago, it's sold off of the rest of the market. That looks like a AAA rated game that people probably want to play. Now, whether they can capitalize on the Web3 model as instead of guys just saying, well, I want to play that game, but I want to play it in my old model. If they convince the kids or the players that, yes, these are your assets, you effectively can move these around the place. When does that become something that people want to actually do? When we were growing up, we exchanged numbers on a piece of paper. When my kids go and meet someone at tennis camp, they go and exchange their online name, right? I don't even know if they know each other's real names sometimes. It's like, Pokey Pig 12. It's like, well, what is that? So anyway, that world is coming, right? Now, can we stay, in this space long enough to benefit from that transition to we just with our wallet on our phone through tokens, we play all our games with tokens. Let's see. But going back to gaming, we really like Echelon Prime. So Echelon Prime is a team based out of Toronto, legitimate operators. I'll touch on why I think they're unique in this space from a team perspective in a moment. But they're running 3 different games. They started with something called Parallel, which is effectively like a card game. And now they're running tournaments globally. So they're in esports. And the 2025 overall prize globally is $1 million. Next year is $2 million. So it's starting to get to the point where this is a game where people are competing for real money. Again, like what you'd see in Web2 esports a few years back. So I think they're at the forefront there. It's got a huge following. They just launched a new game called Colony, which looks pretty legit on Solana. And then they're launching a new game. I can't recall the name of it. It's essentially a layer 3 called B3. But I think they're doing something unique there where they're trying to basically bring people into the gaming ecosystem through referrals, kind of trying to build an ecosystem by benefiting the people that push people in. We'll see if that works. Somebody has to try something here because Web3 gaming has been pretty weak. I talked with the team. They raised $50 million at a $500 million valuation in October 21. Beautiful timing. And so they had a war chest to go and build this out. Luke mentioned earlier, direct dialogue with the team, understanding what these guys are thinking, what their long-term vision is. But most important for Luke and I, and why we actually added to this position, it's been murdered. It was a $28 token. It's $3 today. They decided to lock up their team tokens for 10 years last November. Name another team in this space that said, you know what, we'll lock our team tokens up for 10 years and have invested 10% a year for the next 10 years. Like that's unheard of in this space. And they had already previously rolled their lockups twice before that. So for us, they're dedicated to building this thing out. And whether that takes 3 years, 5 years, they keep rolling out different games. Initially, it was a 1-game platform. Now there's 3. They've got a studio behind it. Like those check a bunch of boxes for us to say, we can hold this token for a period of time, largely because these guys didn't just rug their investors. These guys haven't sold all their team tokens and they're going to move on to the next thing, which is unfortunately happens in the space. You remember the Treasure token, Magic, right? I hadn't seen that thing for years. And all of a sudden I see that they're basically liquidating the business or whatever they're doing with it. So, we want to avoid that at all costs. Hopefully Luke and I have been out of the end before we came to that event. But that's something we really like and something we've added.
Luke, what's in your top 1, 2, top 3 love portfolio right now?
It's also been crushed. Mark and I go back and forth on it. It's called Theta, actually. It's an AI compute video streaming business model that if this was a traditional business, it'd be sitting on the NASDAQ and it'd be worth many multiples of what it is today. It's got top tier partners in Microsoft, Amazon, and Google. It's partnering to most of the great US universities, colleges, and institutions to run AI compute models for them. You can go on and you can right now use their AI compute and all of the different open source large language models, both to generate your own images, go and run your own AI searches, and then ultimately deploy your own models on there. They've transitioned. They initially launched as an ERC20. They've transitioned to their own token. That token has since to its own EVM effectively. I want to say they had 100 and something patents on their technology the last time I looked at it, and they continue to file new patents. Just seemingly a team that's very focused on the niche that they've chosen. They're making considerable inroads that we can see. They're very good at publishing what they're up to and the advances they're making and the wins that they're having. They just clearly articulate the direction they're going on. Now, why Mark and I debated back and forth is because nobody cares. Like literally nobody cares. This thing's also down probably 80 odd percent since the peak. And yet it's got one of the best tech stacks in the space. And it actually has real world use cases that we can see happening. I use its AI models all of the time. And they're as good or if not better than any of the ones that I use anywhere else or I've seen anywhere else sitting in these Web2 business models. So yeah, if you like it, we continue to add. We're very patient there because again, when you look at their roadmap, you look at their communication, you look at the wins that they're having, this is a business model that continues to get better, get more attention and gain more traction. And it's just financial volatility that's causing people to sell, whether they're impatient or perhaps they just don't understand how material some of these advances that made over the last 12 months are. We're not sure. But, again, you talk about valuation in crypto. It's very rare that you can actually point to a business model that has a valuation that is, a fraction of the sense of what it would be trading at in public equity markets, to the point where sometimes we ask them, well, why don't you just pack this up, put it back in equity markets? A whole lot easier for them. And, naturally they believe in a decentralized set of infrastructure that everyone has access to. And we commend them for that. To Mark's point around locking your tokens up and committing to be in this space for 10 years, there are so few people that genuinely believe that and then genuinely have the willpower to actually live that through and can push that. And so when we find teams that are willing to do that and have great plans, great capacity to execute, it's very easy for us to feel comfortable in and around owning them, even if there is volatility or drawdowns you have to go through to come out the other side.
Mark, I want to circle back to real world assets. Right, we've been spending a fair amount of time around RWA tokenization. We've said for quite a while that as it pertains to the NFT ecosystem, it's not just about cartoons. It's not just about digital art. Those are early use cases. But the major unlock is tokenization of everything else, all the stuff around us, which is predominantly non-fungible. And it's starting to happen. We have provided debt financing against GPU chips earlier this year. And that's not necessarily novel because Traditional finance, the explosion of private credit is doing some of that. But we're seeing increasing opportunities, particularly servicing the middle market, particularly servicing DePIN networks and GPU as a service, where folks are looking to tap into global pools of liquidity. Tell us a little bit about where you have focused your research and attention as it pertains to RWA assets.
Yeah, so given our backgrounds, I think it's twofold. Things we think are low-hanging fruit, you described it, loans. So there are listed platforms like you would know, Dan Clearpool, there's Maple, Centrifuge, which we haven't looked at for quite some time. I think, last cycle, Centrifuge was effectively providing real estate development loans as a pool. So you and I could go and we could provide some capital in return for a 15% yield. And that was done through effectively tokenized pools. I think those are still very low hanging fruit. The adoption, convincing someone outside of this space to use a decentralized pool, I still think is a massive challenge, because right now it's going to be natives largely use it, or people who are desperate. I think you have one of the two. Convincing the regular business down the road to go and use a blockchain pool of capital to borrow is not going to be easy. Over time, again, I think it's an evolution of who the market participants are. So that 25-year-old that starts a business might go ahead and do that in 5 years from now because they're familiar with the whole broader ecosystem. And of course, as more liquidity comes on chain, that becomes a heck of a lot easier instead of a handful of guys like us that are looking at providing potential loans on chain. Things like tokenized commodities make a ton of sense. We've seen guys tokenize a uranium stream in Canada and raise money on the back of that. We've had guys approach us about tokenizing some rare earths that are in the ground. We don't necessarily like that because the timeline to potentially mining those might be 30 years. And so you just be holding a tokenized thing in the ground. Well, what benefit does that really provide besides, long duration optionality on something that may or may never happen? But you're starting to see all different kinds of things be tokenized. And one example I always like to talk to people that think it's still magic internet money is the ability to tokenize individual homes. So there's a company called Roofstock. They'll go to Florida and they'll buy a home, they'll tokenize it, and then they'll distribute they'll effectively sell those tokens to you, me, and Lou. Now we own a piece of a home that we would otherwise have to go through the whole rigmarole of financing or buying and title and all that. They do all that stuff on the back end. It's kind of a cool little way to own a residential real estate property that you might earn 7% or 5% or whatever the number is on chain, that you don't need to do anything besides have a wallet and get your monthly yield. So, we look at opportunities like that. We do own Ondo. Wish we would have owned Mantra. I'll say one thing. People don't like to talk about what they've missed often, but Luke and I looked at Mantra. It was a rebadged chain. I think, Luke, it was actually, Dan, it was one of the ICO incubators last cycle that rebadged layer 1 RWA chain, Magic. And so they went from, I'm not kidding, everybody should look at this chart. It was under a cent, or it was a cent and a half at the bottom of the cycle. Thing hit 850 recently. That's one Luke and I think, we could have closed the fund if we bought that at the bottom. It wouldn't be heroes. But the reality is they're few and far between today. And I think a lot of it is more marketing than actual execution. And so something like Securitize, which is not available for any of us to buy unless you were in the, in a VC fund, that's an awesome platform. And I think those types of platforms continue to add more funds on. And, you can go and buy tokenized stocks now. There's an exchange, I think, called BTCC, where I can have a wallet and I can go buy tokenized Apple. Does that matter to me? Not that much, but maybe it matters to some people who only want a tokenized portfolio. And over time, I think that probably, Coinbase is talking about tokenizing their base chain, right?
Well, I think it's going to matter for folks that don't have easy access to
Correct.
Schwab, Fidelity, and other intermediaries to be able to access the stocks.
Yeah, absolutely. And it's
the same example you gave.
we get into with guys that are older than us and much richer than us. I said, well, why would anyone ever care? Like, I'll just use my brokerage account. The pushback we get is often that. Why would anyone care? Why would they buy a tokenized home in Florida? Well, it's because they can't rock up with $500,000 or a $200,000 equity check and get a loan from a bank. So a lot of these assets have been out of the reach of, especially, look at the demographics of America, but there's no doubt that middle class has shrunk over time. And, you see the stat thrown all over the place, top 12% own 88, whatever the number is, but it's a huge number of people that own assets. And so over time, for lack of a better description, democratizing that access, maybe it's a use case or killer use case.
Yeah, and Dan, I think the real world asset component is helpful because it allows a traditional financial analyst or person that invests in stocks to understand that digital assets can have tangible value that they can measure and define. And then once you actually get your head around the fact that there is value to be had here, we often find people looking out of the purview a little bit and say, oh, actually, now that I've actually spent some time to understand how to invest in an on-chain digital asset, I now actually understand the function of Ethereum or the use case for token A or B. And actually, I want to talk about what you see there more because naturally there is absolutely opportunity that I really didn't know even existed before I actually jumped into the space and started having a look around. And I think that's how Mark and I got here. We think through time, a lot of people will get here, whether it's stable coins that brings them in, it's investing in real world assets on chain that brings them in. It gives, you finally get asset pools that are large enough for traditional markets to care about. Like I think about right now with all the trade disputes, who's going to buy US Treasuries in the future? And finally, the conversations turn to, well, digital asset markets are, I think, the 7th largest owner of US Treasuries today. And the US is finally understanding the importance of having those markets and being able to sell a treasury to an individual that's sitting in a country that never otherwise be able to own that treasury because they can access it via a digital asset instead of accessing it via, having it via a local government bond that they've only ever been able to buy. So that landscape can change very quickly. And then all of a sudden, as a US-centered, currently US dollar base, I guess, or a global treasury market that sits and exists on chain, you're going to have the rest of the world that will only be able to access US treasuries on chain. And so again, that will bring a lot of non-US capital into this space, which it has always been our hope that you'd actually finally see some more institutional adoption outside of the States or even within the state, but it's pretty slow, but it's coming.
People will be very pleased to avoid using treasurydirect.gov.
Yeah.
I can assure you that I have navigated that site for many, many years, and I'm thrilled about the opportunity of being able to access treasury notes that are tokenized using 21st century rails. I want to ask, the first is, we're seeing a growing set of assets where cultural relevance and financial utility are intersecting. And that's where we have been spending a lot of our time. So from where you sit, is that convergence investable yet? And if so, how are you going about it? Mark?
Yeah, so, Dan, we initially met through a different business that looking at our investors in. We were effectively doing that, and it wasn't easy. And I still believe in it. And we still think ultimately, as the users, as I mentioned earlier, maybe it is the next generation of people want to own a cultural asset in a tokenized form, or want to be able to use the metaverse to visit a pyramid that they can't afford to get on a plane and go to Egypt. This isn't novel. I mean, people have tried to do this a bit. It's here and there. There's a few companies, we've looked at over time that we thought was a really cool business model. Whether they're around today, we don't know. But the trying to convince someone to do that, especially in a time and place that are extremely difficult, digital asset markets, has been really tough. And so to answer your question, I don't know how it looks. You've even had, Dan, high profile, like the Picasso family. They went and tokenized some of their things a few years ago. I've not looked, but I would love to go and look to see what value now is ascribed to some of these, call it not lions, PFPs of lions, which I think have all gone to zero, but things that are actually real art that has been tokenized, for example. And how those things have, and you could answer this question, I'm sure, have those held value much better than, say, the PFPs? And over time, do those increase in value over time as people return back to this market and the on-chain art is existed?
Yeah, no, I don't just that, Dan. The difficulty actually isn't, I don't think, in the art that's being created, the metaverses that are being built. It's in the reason why we should use or care, or, how do we actually shift behaviors away from what we're currently doing into the model. And in many cases, actually, the reason a lot of these things don't work is because there's no incentive structures help them to work. For example, all the hardware providers are centralized Web2 businesses. They don't want to open access for people to use Web3 products. Most of the collectors in the space are, centralized collectors that have owned physical pieces of art or contributed to various different points physically in things, and they're just throwing a little bit of risk capital into the digital world. And so they're not really here for anything other than just to understand the space. There are one or two winners here that are supported by a handful of collectors that continue to figure out how to make money in this space, but it's not long-term money. It feels very much like, pump.fun, and you launch tokens and you harvest, and then the people that basically buy whatever it is you're selling are the ones left holding the bag. Ultimately, then aftermarket support. Again, we talk about it a little bit with tokens, but so different metaverses or digital art or whatever it is. If there's not aftermarket support, if there are not people that care about this, if there's not guys that are actively bidding on floor prices constantly, you're falling victim to just an illiquid market that may or may never return in a space where you still don't have enough tangible people trying to justify fundamental value yet. Now, that's not to say that's not coming. It's not to say that if you're not in good projects will return. We genuinely believe that there will be projects that return. There will be a handful of projects that make it out the other side of this. The question more for us is that we're having trouble telling people to invest in real infrastructure businesses that you can use and contribute to and make money from today. If the majority of investors don't want to even understand that, like, how will they go one layer deeper or even a layer deeper again in understanding that there are use cases across loads of different industry applications here that have great opportunity that they're not looking at, that they should have exposure to. Ultimately, people just look at that as they glaze over and they say, look, this is too hard. Come back when I can get a less easy to read white paper that tells me exactly how I make money and how I don't lose money and how I can get my money back at any point. Maybe think about it.
And let me just add before Luke on that. Like, Dan, one of my 10-year-olds today, he's going to a digital art class, and he came from yesterday. It's a 2-day digital art class. That generation, that will be their palette, right? He takes his iPad. He's got a stylus. They come back. He was cool pictures yesterday. Brought this one that this 14-year-old kid did that looked like you could sell it on OpenSea or whatever, right? So that generation, they're not going with a paintbrush anymore. Again, it sucks because, he's only 10. It might be 10 years till, when we think about adoption and timelines and everything, but that certainly, that again, it's just going to be it's going to be the way that they natively do things. So I just put it on mute. I'll put it on mute. You can edit this out, but I'll put it on mute. It's an hour and a half now. So they're probably, my wife's, be quiet for an hour and a half. Hour and a half.
Wrap up. Yeah, exactly. I hear the painting prodigy here. So very last question, guys, because we're focused on reimagining ownership and everyone has their first recollection, their first memory of something that they felt true ownership of. Luke, do you remember an early instance where it was some object that you were able to take possession of and felt the joy and the pride of ownership for the first time? And then Mark, I'd like to hear from you.
Yep. And I still have it. And if it gave me 2 minutes, I could find it. It's 1994, maybe 96. Michael Jordan, Mr. June card. And it was, I don't know, maybe I bought it for $1 in a pack of cards back then, whatever it was worth. And I think it's worth a few grand right now. And again, I've not checked into it. I actually during the 2021 NFT craze, I went and found it because I was like, hey, this is actually a physical version of what these guys are launching now. It probably makes sense. But yeah, like it's mine. I keep it in a case. I know exactly where it is. You know, to be fair, I've lost it a handful of times in my life because, you know, it goes into a box, it goes into mum and dad's garage while I'm traveling. Now I'm, you know, living obviously not there anymore and not different cities and all that sort of stuff. So who knows how it survived. But yeah, that's something that absolutely I remember.
Yeah. No, I'll give you two, Dan, because Luke covered the cards, but I had a Mickey Mouse phone, and it actually, the white glove hand was the ringer. So I love that thing. And I think
we need to bring that back, Mark.
I'm about to track down where it is. It's probably in my mother's garage in Florida. Who knows? And then second is a John Elway rookie card, which one of my brothers has. And I'm not convinced he hasn't sold it. He went and got all of my card. I probably have tens of thousands, if not more, worth of cards because I have a bunch of, I was born in 77. You know, there was a lot of Michael Jordan and Elway, all these guys. Well,
there was a lot of production, though. Late 80s, early 90s.
I remember it well. And so I know he grabbed that out of my mother's garage.
Now, if that was on chain, we would know.
Exactly right.
We would know if that transacted.
That is truly.
You'd be able to go and get that pound of flesh back.
Well, I actually just wrote a note. Call Matt regarding baseball cards. So I'm gonna see if he still has them. I don't trust him.
At a minimum, there's going to be some value that is extracted from today's session.
Correct.
And I'm very happy about that. I always love speaking with you guys. I would enjoy having you back because I think there's a lot more to talk about when it comes to easel and your interests in digital culture. So I table that for now, but hope we can reconvene sometime soon. Wish you guys all the best. And I look forward to visiting with you in Australia at some point.
Absolutely. Thanks, Dan.